What is up, YouTube? This is the Working Investor. Today we're going to talk about does the net asset value matter when your high yield dividends are paying a crazy amount? Some people argue and they say that if you're getting 100% return in a year, then you're just playing with house money. I argue that yes, that does have, that could make sense. If you got 100% return, you're playing with house money, then you've completely de-risked your own money. But I like to win in multiple ways. I like to have multiple ways to make income to really maximize your entire return. So I like to actually preserve NAV. I bet you, even if one wants to argue and say that the NAV does not matter at all and you have such a high dividend, who cares? I'm sure that if your NAV would be preserved, that would even give you a higher stance, a higher footing, a higher footing in your investment. So let's talk, for example, I have Coney and fiat. So I do basically a hedge. I do a synthetic covered call. I use a synthetic cover call ETF with Coney, and then I use a synthetic cover put ETF with fiat, and I juxtapose these against each other and they hedge against each other, effectively doing like a synthetic covered strangle. And synthetic covered strangle is an option strategy. Like a strangle is an option strategy where basically you're kind of neutral-ish in the position. So if a position kind of stays within a range, it fluctuates within a range, you're kind of a winner. If it goes extreme in one side or the other, it could be, you can get in trouble. It's not a perfect hedge. I'm not a financial advisor. Look at the prospectus. They even say it's not going to be it's not going to be promising to be a hedge. But there's a couple of reasons why I like to do it. Number one, I put 10,000 into this position, right? I put 5,000 to fiat, 5,000 to Coney. This was pre-dividend distribution, so there was a lot of changes, and you could see that I'm actually have my entire $10,000 in my pocket, even though each side had some fluctuations. Also, I did get some dividends, which kind of were part of this equation, but that's part of the, I want to see my overall return. I want to see if I have my $10,000 back. Also, like I can also use once, they say you want to buy low, sell high. So here I have two funds that are juxtaposed to each other, polar opposites. They work in inverse correlation to each other. So like, when I do this because of, I'm looking at Bitcoin, right? So the Coinbase, which Coney is a derivative of, Coney is correlated with Coinbase, and Coinbase is correlated with the price of Bitcoin in general. Plus, they have their own ways of running their company, but very highly correlated with Bitcoin. And I don't care if Bitcoin goes up or down. I just know it's very volatile and it's cyclical, and whatever it does, I make money because I'm making money on each side. I'm making money on the synthetic covered call with Coney, making money on the synthetic cover put with fiat. And so I'm a winner overall, but also I get to enjoy to have a preserved net asset value. For example, Coney was down today, and basically I was able to buy, I was down like $65 in my position today, and you can see here I bought 5 shares of Coney, and I reduced my cost basis for almost $76, but that money didn't come out of my pocket or out of my account. Fiat was overpriced, so I sold off a few shares of fiat. You can see right here, I sold $81.48, 4 shares worth of fiat, and I used the proceeds of the fiat was higher in my allocation, and I used the excess to buy Coney. But as you can see here, fiat still has like $60 above my cost basis, so I can actually sell off $60 worth of fiat and keep that on the side, tuck it to the side for a rainy day, use it to buy a different high yield ETF, build that up to a few $1,000s. I can use that. The same thing with Tesla and Crash. They are juxtaposed. These are opposites: synthetic cover call, which is Tesla; synthetic cover put, which is Crash. And I don't care what the price of Tesla is. Whatever happens, I make money on either end. And again, I was able to lower my effective cost basis, with Tesla, because you could see here, Tesla was down, and I was able to buy more shares, lowering my cost basis, not with money out of pocket. You can see here, I bought 5 shares of Tesla for almost $64 and change, but I used the proceeds of Crash, which was overpriced, based on my allocation, and I sold 4 shares for $64 and change. I used the proceeds of Crash into Tesla. Now I'm back to being whole, and I've reduced my cost basis, and I'm sitting here. If I want to get out of the position right now, I have all my money back of Tesla, Crash, Coney, fiat. I have all my money back in my pocket, and I'm just sitting here making money. Then in VIDI and dips, I have a 65% allocation. It's a $10,000 total investment, 65% in dips, 6,500 in dip. I'm sorry, in VIDI, and 3,500 allocation in dips. Right now, I did sell off a little bit of NVIDIA and bought some dips, and you can see dips. NVIDIA is going up, and dips is going down. So I'm close. If you add these up together, I'm actually more than whole. I actually have a little bit of excess, but I'm not going to rip off because it's less than $50 to $100. So I'm just going to hold off on that. So yes, there are some benefits with preserving your NAV. I mean, of course, if you get 100% return in dividends, of course, like you're playing with house money. If you put in 100 grand and you got 100 grand, you got your 100 grand back in dividends, and now whatever, and then you have these shares left over. Who cares what they do? They erode to zero. You don't give nothing to. You've completely de-risked your portfolio because you already have. You're completely whole. I totally get it, but there's also I'm sure you can argue and say that there's other ways to make money and other strategies if you preserve your NAV, especially if you're using margin. The NAV, net asset value, really, really helps. You know what I mean? So that's why I like to make money in multiple ways. I like to make money with the dividends. I use the hedging to kind of try to preserve my NAV. I lower my cost basis. Very important, I also have a higher, if you lower your cost basis, you have something called a higher effective yield on cost. Like if you bought, because if you bought underlying, let's say for $30 a share and it pays $1, that's a certain percent return. But then when that underlying drops to $20 a share and it still pays $1, your yield on cost is lowered. So because you lowered your cost basis, you lowered your yield on cost. And I get the dollar cost average without any extra money. And also, if I have excess after that, I can rip off the top and just use it for myself, or use it, enjoy it, or put it away for a different investment, or if everything tumbles down, I can kind of have a little bit of a hedge of safety. So I just wanted to share with you my 2 cents about, preserving the NAV, not preserving the NAV. I'm sure, like I said, I'm sure most people would agree that if you preserve the NAV, even if you want to say the NAV doesn't matter, which I disagree with, but even those who believe that it doesn't matter at all, you have to agree that if it is preserved, it just puts you in a better position. This is my 2 cents. This is the Working Investor over and out. Hope you guys have a wonderful trading week. Lots of luck and happiness.